Are you still paying PMI, private mortgage insurance, on your mortgage? Well, good news, this could be the ideal time to get rid of it. I'll explain that more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, my favorite dad joke right now, and it's just the worst one ever, our housing prices are through the roof, right? And there's pros and cons with that. But one pro could be if you previously didn't have enough equity in your home and therefore needed to pay private mortgage insurance or PMI as an extra cost. With the housing market surging, 18% increase year over year on average, some areas more, some types of houses more, you may now suddenly have seen your house value increase such that you now have enough equity and you can get rid of your PMI, your private mortgage insurance. All right, so real quick, what is PMI? Hopefully you don't have it. But if you do, okay, it's an extra fee. It's an extra cost that your lender, that the bank charges you if you don't have enough equity in your house when you take out the loan, okay? Basically, the lender is on the hook. They're saying, well, we're loaning you this money, and therefore, how much compared to what you're paying compared to the value of your house, how much are we lending? Like, how much shock absorber is there that if the market value drops, the housing value drops, and you default on your payment, how close are we to the bank, the lender, to being underwater, right? And if there's not 20% equity when they give you the loan, if you don't have 20% down or you don't have 20% in equity, they're going to charge you an additional fee. Now, they dress it up, the language, like the term, the label is, a little bit friendlier than what it is. They call it private mortgage insurance. Sounds like you're getting this extra benefit. No, it's just a flat out extra cost because you don't have enough equity. You didn't have a big enough down payment. For example, if you bought a $200,000 house, 20% of that would be 40 grand. You need to put 40 grand down in that house in order to have 20% equity. If you did, great, and your monthly mortgage payment is just going to be principal and interest and maybe escrow, okay? If you put something less than 40,000 down, okay, then you now don't have 20% in equity. You didn't put 20% down, and the bank's going to charge you this PMI, okay? Traditionally, this PMI, private mortgage insurance, has always been an additional monthly cost added to your mortgage. $100, $150, there's calculations for that, but somewhere in that range. Over the past few years, I've seen more and more banks charge a private mortgage insurance fee, a one-time fee when you originate the loan, okay? Instead of having a monthly payment, you pay it all up front. And if you've done that, and sometimes that math would work, but if you've done that, now that values have surged, that may have been the wrong choice. But traditionally, PMI is something that's added to your monthly mortgage payment, and you've got to pay that until you get enough equity in your home or pay your loan down enough. Well, voila. Without you doing anything, home values have surged, right? So now if you previously didn't have 20% equity in your house and the value of your house increased 20%, voila, there you go. You now have enough equity and you hopefully can get rid of PMI. So then the big question, how do you do so? Well, traditionally, one of the easiest way, I've often told people, once you get into PMI, very hard to get that stink off of you. It's very hard to get out of PMI and get rid of it once you start. So a few years ago, even a year ago, I would have said, the tried and true way to cleanly get rid of PMI is to refinance your mortgage. You probably get a little bit better rate and you restructure the loan, and then you don't have that PMI, that payment to begin with. That's probably the easier route. And again, if it drops your interest rate, fantastic. Nowadays, no way. There's no way you'd refinance because likely the interest rate that you'd get today would be significantly higher than what you had before. And so I would not assume that that's the default option, even though it just was a year or 2 years ago. Now, if you have PMI and you're now looking and saying, wait a second, the value of my house has surged, I bet I have 20% equity, the way to get rid of PMI is to reach out to your lender. You've got to reach out, and I would not wait, okay? Reach out to your lender right now, whoever, whether that's the bank or you went online, whatever, reach out to your lender and ask them to reevaluate or what the process is for you to get rid of your PMI, okay? Typically, I'll just tell you, there's a few traps, okay? Number one, they're going to tell you what's written into your actual contract, actual mortgage, okay? Some of them say that once you originate a loan where you've got PMI, you're not eligible, you're not even able to get rid of it for 3 years or 5 years. They might have a term at which they're not even going to reevaluate. Whether you paid it down, whether the value increased, you're stuck with it for at least 3 years or 5 years, whatever. That's why, I mean, you can read through your loan document, but reach out to the bank and ask them, okay? That's number one. Second, they're likely going to charge some sort of fee to reevaluate, okay? Which is why in the past, in many occasions, if your interest rate was a little bit better, just refinance, because there'd be a fee for that too. But if you can get a slightly lower interest rate, it's going to cost you to get rid of PMI anyway, so just refinance. Not the case anymore. So just be prepared. They might charge you a fee, okay? 3, they might require an appraisal, okay? And honestly, it's going to be very interesting to see if these housing values firm up and values even drop a little bit. We will see. And if that happens, banks are going to be not as excited, okay, about getting rid of your private mortgage insurance, because housing values spiked, and then they could, if they start coming back down, banks might be a little more restrictive. So no, you might need to get an appraisal, which also would come with a fee as well. And then the last thing I would tell you is this is, even though it's called private mortgage insurance and sounds like insurance, sounds like you're getting some sort of benefit. No, this is an extra cost that you're paying to the lender. This is, just for not doing anything just because you didn't have enough equity. They're getting more revenue. They're not going to be too excited. They're not going to be too excited about dropping this. Don't expect this to be a very easy process where you reach out and say, hey, I bought my house for $150. It's now worth $200. Get rid of my PMI. They're not, it's unlikely they're going to say, yep, no problem. It's erased. You're all set. Here's your new payment. It's going to be a more cumbersome process than that. But work with your lender. Go through whatever their process is. There'll likely be a fee, there'll likely be an appraisal, and it will likely take longer than you think it should. But if your home value has increased significantly, likely it has, it may be the right time, I would suggest it's likely the right time to get rid of PMI. Have any questions on any of that or making any home decisions? Maybe you've got extra cash and you're wondering, should you put it on the mortgage to try to get rid of this PMI, something like that? Work with your certified financial planner. With all the volatility happening in the market and the economy right now, and certainly with houses, you need financial wisdom. So work with your CFP on all 6 areas of your financial life. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well. Or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.